accounting in the books of lessor. We have seen how to do accounting in the books of leasee. Now we have to see how to do accounting in the books of lessor. Lessor means the one who gives the asset on rent. Now there can be two scenarios. Either the lease is classified as operating lease or it is classified as financing lease. If it is classified as operating lease, it is straightforward. Point number one, asset remains on lessor's balance sheet because he's given it out in the form of operating lease, a genuine rent transaction. So asset remains on lessor's balance sheet. Second, every year he will charge depreciation. And third, lease would be shown as a part of income on income statement. Lease would be shown as a part of income on income statement. But if it is classified as finance lease, then there can be two separate scenarios. Either it can be sub-classified as direct financing lease, or it would be sub-classified as sale type lease. Either it would be classified as direct financing lease or it would be classified as sale type lease. Have you understood the operating lease part? Extremely intuitive. A genuine rent transaction. You are the owner of the asset. You give it to someone on rent. Have you sold the asset? No. So the asset remains with you and therefore you would keep on charging depreciation. But every year you would receive rental income. And then that is your part of your income. So you would show that on the income statement. Are we fine with this? Now let us understand what is the direct financing lease. Direct financing lease. Let us say this is leasee. Leasee is in need of an asset. He wants to purchase an asset. This is a NBFC. NBFC is non-banking finance company. So business of this company is to give loans and earn interest. That's the business model. Right? So raise money at a relatively cheaper rate and then give loans and earn interest. Now, leasee, though he is in need of an asset, he would like to take a loan. He would want to purchase the asset using loan. So what he will do is he will go and approach NBFC saying this is the asset that I want to purchase. Now there are two possibilities. One, that this person who needs the asset will buy the asset and for that asset that NBFC would give him the loan. But a more secure way is, because in the first format the ownership of the asset is with the leasee, the one who needs the asset. A more smarter way of structuring the transaction is, if this is the equipment manufacturer. Let us say value of the equipment is 100,000. This NBFC will go and purchase the asset from equipment manufacturer. Then it will take that asset and give it to this leasee in the form of lease charges. So NBFC will buy the asset and then give it to leasee in the form of rent. And let us assume that this NBFC would like to charge an interest at the rate of 10%. So let's find out how much is the installment for 5 years. Second clear TVM, 100,000 present value, 5 is N, 10 is IY, compute payment, 26,379. So what is the essence of this transaction? The essence is that this NBFC in a way indirectly has given loan of 100,000 to the leasee and he is going to repay in 5 installments of 26,379. But to add that element of security to the transaction, the ownership of the asset is legally not kept with the leasee, it is kept with the NBFC. So it purchased the asset and then it gave it to the leasee. So this lease, now from an accounting perspective, okay, so not from economic perspective, accounting perspective, the accountant of leasee will say, now see how accountant is thinking, this part you don't have to write. He will say, we have taken an asset on lease from this NBFC organization. The lease charges are 26,379 over the period of 5 years. Present value of lease payments is more than 90% of the value of asset. It is to be treated as capital lease. How this NBFC will say, the accountant of NBFC, it is a capital lease, but it is of direct financing lease because this NBFC was not itself the manufacturer of this asset. Therefore, there is no gross profit. For example, if I had been the manufacturer, I would charge some profit before selling the asset. But in this case, there is no profit on the sale of asset. The only income that this NBFC will have is in the form of interest. Is that fine? So this is a structure of direct financing lease. Write down this part, then I'll show you how accounting is done. Are we done here? So how to account for direct financing lease? Direct financing lease, which is a type of finance lease, is in a way selling the asset. Make sense? Therefore, number 1, asset will be removed from balance sheet. Makes sense? Because we've sold the asset, so asset should not be on balance sheet anymore. Number 2, so this asset in bracket you can write down machinery. Number 2, a new asset will be created. New asset will be created, which we can call as loans and advances. Because when we sold the asset, we did not receive the cash, but we received the promise that the cash would be paid to us in installment for 5 years. So that amount to be received from leasee, that would be shown as a new asset. And every year, once installment is received, principal portion will reduce loans and advances, and interest portion will be shown as a part of income. Every year as the installment is received, principal will reduce that loans and advances, interest would be shown as a part of income. Okay, let's create a balance sheet to understand what this means. Do you want me to read out any part here? Every year, once the installment is received, principal portion will reduce loans and advances, and interest portion would be shown as a part of income. Okay, let's see how does it work. Let us say this is the base case balance sheet. Let us assume originally we have equity of 500,000. We have cash of 500,000. Okay, I've just assumed this part. Then we, as an NBFC, we first decided to purchase the asset so that we can give it on lease to the leasee. So when we purchase the asset, 100,000 will go from our cash. So cash now is 400,000. And then we will have that machinery, let me call this simply as PPE, property, plant and equipment, 100,000. But we take this asset and we give it to the leasee immediately. Fine. So after the lease agreement, so let's create a new balance sheet. Let's call this balance sheet as after lease agreement. So the moment lease agreement is signed, I'll give you time, but just focus right now. Then how will your balance sheet look like? Now the moment lease agreement is signed, that property, plant and equipment is now with the leasee and it is in a form of sale. So this PPE now would become 0. But we will have loans and advances given. Loans and advances of 100,000. Cash of 400,000, equity of 500,000. Then what will happen in year 1? So at the end of year 1, now let us make the balance sheet and income statement. Now year 1, how much is the total amount that we are expected to receive? Tell me. 26,379. Out of 26,379, how much is interest and how much is cash? 10,000 has to be interest because 100,000 loan into 10%. 16,379 is repayment of principal. Okay, so now see your balance sheet carefully. How will we pass this entry? Equity remains same, 500,000. Equity remains same, 500,000. Then we have loans and advances. It was 100,000, but leasee has paid back 1637. Let me just round it off. 16,380 out of it. So since 16,380 principal is paid, how much are we left with? 83,620. That interest of 10,000 is a income. So interest income 10,000. And cash will increase by how much? Entire 26,379. So cash 426,380. And that income eventually get transferred where? Interest get transferred as a part of equity. So we will have income of 10,000 here, and the balance sheet will tally at 510,000. Take total of these components, it will come out to be 510,000. Followed? So we remove the asset, then whatever installment we received, principal got reduced from that asset of loans and advances, and interest component was shown as a part of income. Yeah, loans and advances, but accounts receivable would be an inappropriate term to use because it would not be paid back in 1 year. So it's not a current asset, it's a more longer tenure asset. Are you done writing this? So here you can give adding purchase of PPA entry. Now the second type of lease. So let's not lose the big picture. What's happening here? The topic that we are on to is long-term liabilities. Within that, we are learning to understand how to account for lease type of transactions. Within lease, we have already learned how to do accounting in the books of leasee. Right now, we are in the books of lessor. Now, if it's operating lease, it's straightforward. If it's finance lease, there were two subtypes. The first one is direct financing lease, where the intention of the lessor is just to earn financing income, which is the interest income. The second type of lease is called sale type lease. Now see, how does the sale type lease work? This is again the lessee who needs the asset. But this time he does not go to NBFC. He directly goes to the equipment manufacturer or PPE manufacturer. And he says that this asset I want to purchase from you. So I want to purchase from you this asset. But I cannot pay you entire 100,000 right now. Rather what I'll do is I will pay you 26,380, 5 payments at the rate of 10%. But this equipment manufacturer, his selling price of that equipment is 100,000. But since it is his business to sell these type of equipments, his cost to manufacture was only 80,000. Correct? This profit element we did not have in case of direct financing lease because the purpose was not to make profit. Correct? But here, will we have a gross profit? Yes. So the entire accounting would be exactly same except for the fact that at the beginning of the transaction in a sale type lease, there would be an amount of gross profit. That's it. Otherwise, the treatment remains same. we would recognize loans and advances 100,000. Every year we will have interest income. Principal portion will reduce the asset. Only difference would be at beginning, at time 0, we will make an entry for gross profit of 20,000. The question is asked, when we buy a car from a dealer, is it a sell type lease? The answer is no, because you use the word buy. When you buy the car, it's not a lease anymore. When you lease the car, then we will have to decide what type of lease it is. Are we fine here?